All right, so welcome to this weekly session. We do these weekly live sessions for SunGard New York Portfolio and everything else associated with our company, SunGard Investment Publishing. We're doing it for really anybody who finds us at this point. A lot of people on Seeking Alpha, people that know us from Substack, people that know me from social media, etc. uh, Probably in the next few weeks or so, we're going to make this a subscriber only thing. And part of the reason is because it's getting popular. I'm happy to say every week we seem to have more and more people signed up, and more people are actually able to attend. And I want to try to be able to craft this into something that really benefits or shows people the benefits of being a subscriber to SunGard New York Portfolio. Uh, because one thing that is pretty clear to me is that these markets are changing. I've been writing about this. I've been speaking about it really to anybody who would listen for the last couple of years, but I think it's starting to get into the public consciousness now. Um, like they say, there's early and there's wrong. I've been wrong plenty of times. I've been early even more times. But I think some of the things we're talking about and have been talking about really over the last year are starting to come to fruition now. In fact, a lot of them I think are just being looked completely over the head of a lot of investors, and certainly the media, and definitely the product providers, because the worst thing that they could do is to say something that would go against, buy my product. So uh, I'm going to walk you through. I've got a fairly tight agenda here, because I always want to get to the point where it can make it, kind of open season, ask me anything. The main topic this week is how I'm using ETFs, different ways to use them, and so we'll get to that in just a couple minutes. I'm going to start with my current take on the markets. And if you are a Seeking Alpha subscriber to the general Seeking Alpha, not necessarily to our investing group within it. By the way, if you're not a subscriber, I believe we have a 20% discount code. I think it's 300 a year normally, so I'd make it 240. I think you can cancel anytime. It's a pretty good look, and for a lot of people, I mean, I will write literally 250, 300 articles there this year. So you're not going to necessarily get everything I'm saying, but you're going to get a pretty good flavor, especially a lot of the macro stuff. So I can't say enough about Seeking Alpha, and they did not tell us to say that. So let's start with this, which is actually my Seeking Alpha article that came out this morning. I like alliteration like the next guy. So I think this market is about the three T's. It's about Trump, it's about Treasuries, and it's about tech. So I'll just give you a couple of highlights from the article. Okay, Trump. I mean, look, not as I said in the article, not one iota of political talk in there. It could have been tariffs, all right, because that's the main thing. And I would say the uncertainty of the uncertainty that comes with a lot of things that are supposedly intended to happen, everything from how immigration impacts economic demand because there are fewer consumers if a lot of them are taken out of the country. We've all read about these, I'm sure. So what we don't know is which things that actually are discussed and intended are going to happen and which ones aren't, and what's their ultimate outcome going to be. I think what I actually said in here is that it is really more about not trying to guess our way through this, but like I say, I let my chart work tell its story, then I listen to it, and that that's just how I roll. So read that article if you get a chance. I think it's a pretty good updated one. I mean, I literally wrote it just a couple days ago. So, secondly, so Trump / tariffs are the first T. The second is Treasuries, and again, what happens with this is going to roll into what the bond market is looking at right now, and like I say, the bond market's acting as if something is different. And all you have to do is look at where the yield curve is today, which is in blue. Okay, so these are the very shortest term. These are T-bills all the way out to here, and then 2-year, 3-year, et cetera, out to here. Okay, this is a closer to normally sloping yield curve. Okay, if you treated the T-bills all as one, you would, you'd have pretty much a straight up. We haven't had that in a long time. I mean, a very long time. And wow, has it changed dramatically in just 3 months. Ironically, right around the time the Fed was starting to cut rates. And yeah, this is what happens when the Fed cuts rates. This has nothing to do directly with the Fed cutting rates because the Fed only controls overnight rates. But what has happened is two things going on at the same time in the bond market. And frankly, I think I made this point in the article. I said there are two different but very beneficial situations, particularly for income investors. Well, the first is these T-bill rates and the shorter term bonds are still at very competitive rates. A little sneak peek, I'm going to write something about a very elemental, I guess, equation involving 3-year bonds and what you can do by combining 3-year bonds when the rates are here or even higher, perhaps in the coming weeks, with an aggressive portfolio, what we call a barbell. I've also called it macro track. So we have a bunch of names for it. But the point is, this is great if you're an asset owner. Not so much if you don't have a lot of assets you can put to work here, but this just gives you it gives you time to wait. Sometimes you'll be like, well, why should I lock in a T-bills? They're only yielding, 4 point whatever percent. Yeah, well, give me 1% or so a quarter, and in the next 3 months, and I can sell it anytime, especially as through an ETF. I do it every day. And I'll take 1% on a part of my money to be able to have no downside risk effectively, and see where the world is 3 months later. Frankly, if you had done that 3 months ago, you would have locked in 3 months up here. And yeah, you'd have to reinvest it down here, but this is still a very good rate to me. And I think it's lost on a lot of folks. The other thing that is happening is at the long end.
Or you build strength, increase your mobility, flexibility, and boost your circuit.
Rob, I think maybe you're on mute now. I don't know. You're still on mute. There you go.
Okay, I was on mute. That's the strangest thing, because whatever that noise was, it wasn't coming from here. Okay. All right. So which parts did we miss, if any? Talked about the short term. Talked about T-bills. So at the long end, it's the opposite story. If you ask most economists, you would and you said, okay, the yield curve was sort of awkwardly or invertedly sloped, where long-term rates are higher or lower than short-term rates. And then it reversed itself. The first thing an economist would say is, oh, guess the recession's coming soon. I don't know if a recession is coming soon. I just know that it won't take much for the market to start to worry about it if there's incremental evidence. In the meantime, what this is doing is this is such a lift, and the reason this is likely happening, I don't care too much about the reasons. I care what is happening, not so much the why all the time, because the why doesn't really matter if it's all about price movement. So, the fact that long rates have moved this much is an indication to me that there may be some concern finally that the US debt is becoming unsustainable, and that rates that the bond market demands are going to have to be higher. They're not going to settle for, oh, just give me 5% for 30 years and I'll feel good about that. If you just think about it like super logically, 6%, 7%, 8%, if you were going to give your money to somebody who's got the debt profile of the United States right now, and you said for 30 years, would 5% a year be enough? For a lot of people, I don't think it would be. So just think of it that way, and say, where are they actually going? So that leads to an interesting way to try to make money, what I call exploiting things like this, and I'll get to that in a moment. And then the third T is technology, as in technology stocks. So, and in particular, there are three of them that make up about 20% of the stock market right now. So, and if you add the global market in, there's still probably 15, 16% of it. So it is not a stock market. It's a market of a few stocks and then the rest. And you can see this really just with NVIDIA. Okay, this is not a long period of time. I mean, this is going back to end of September 2022, which is kind of when that whole AI rally started. I'll leave it to other people to figure out how much of that 1,000% move in NVIDIA since that time needs to be given back, if any. But you can see here, okay, that along with a couple of the big long-time chiefs of the S&P and the NASDAQ, Microsoft and Apple, both doing better than the broad index. Well, if you look at the average stock, it is not the same picture. I mean, it is most stocks over this time are anywhere from a third to a half of this, and a lot of them are negative during that time. So anyway, that's a quick run through on the three T's. I'm going to give you a quick chart view here, because this is the other thing that I am finding to be quite intriguing here. Okay, see if I can do them from memory. And I'm going to do this because it's a little nicer to see at this time of day. Okay, so I say there's a bunch of major macro indicators, and obviously they're ETFs that you can buy, but I'm using them as macro indicators right now. And I love it when I forget to take markers off of my charts, because then I can come back and say, oh, wait a minute, I must have highlighted this in something. Yeah, this was a potential sign of high risk not long ago. And, sure enough, I mean, NASDAQ's maybe 6% off. But this is what I'm looking at, okay? And again, these are drawn not precisely, so maybe there's a little bit more room there, okay? But is kind of connecting the dots down here. And what I'm seeing is that, if the NASDAQ 100 QQQ does come down to this area, which is telling me here there's a good chance it will do it, then if it stops here, that is a good sign for a bull. If it breaks through here, not for a day or two, but if it breaks through, maybe even tries to rally back and then doesn't, that's what we call failure as technicians. And that could mean something worse. How much worse? I don't know, but let's remember how we got here. One of the things that I can definitely picture myself saying a little bit later in the year is to say, hey, I mean, think about it now. We might as well get ahead of this, right? Okay. I don't know where it's going. I just know that I want to have an idea before it gets there. And look, this is where we were 9 months ago. The Qs were at 415 9 months ago. So if we simply gave back 9 months of gain, which is not a lot, right there, you're talking about a 16% decline on top of what we've already had. So probably 20% decline in total. Okay. That would be unsettling for people that are not ever used to losing money for very long. So again, I'm here to try to spot risk, account for it, and then I'm trying to make as much money as I can. But that's what avoid big losses. Okay. Now, I explained it there. The SPY is already ahead of it. So what I said before about, okay, maybe rally back is going to have to do it soon. Otherwise, we start dipping over, and I'm going to substitute the weekly for the 3-day here. Okay. This is earlier stage. You see how this is already plummeted through zero. So that's change in momentum. Daily chart, not as, you know, it can be very useful. It can also be a little more deceiving. A 3-day, not so much, and a weekly, not so much. So, I mean, yeah, if I had to put odds to it, I would say the odds that the next 10% move, because this is how we think of a lot of things. The odds of the next 10% moving down in the SPY, not up, I would say at least 70%, maybe 75, and definitely increasing. And this is what determines the ROAR score and the ROAR portfolios and things like that. All right, I'm going to go to another one. This is an easy one to pick on because the small caps, especially the Russell 2000 small cap index, are frankly such a pathetic group of companies from a financial standpoint. I think 40% of them are only alive because they can borrow. And I'll show you in a second, the cost of borrowing look like they're going up. So this is already busted through. And this is also not a good sign here. Where could that go? As even an intermediate stop, because it landed there a lot of times before. Well, 163, 160, something like that. Yeah, that's 25%. The small caps have one hand tied behind their back already because of that financial condition. It's not like they have the Mag 7 in their mighty balance sheets, and their sort of rock star status to lean back on. And of course, the S&P, so much of the S&P is dominated by the big NASDAQ companies, so it kind of lifts that tide also. Okay, one other thing I'll show you here. Okay, this is the average S&P stock. So in those terms, you've already got a correction from 188 to 175. So I mean, you're only talking maybe 7% down. Just going to do a quick check here. The top 1,000 stocks, equal weighted, and about 8%. So it's, you know, it's kind of rolling over onto itself. I'm going to mention the rates one more time. And this in particular, this is 30-year yields. So, I mean, we have to go a way back, okay, to see when this was here. So I don't know what's going to happen here. All I know is that if it busts through this area, other than a small spot here, okay, 5.1 on the 30-year bond could be 6.5, 6.75, like that, if there is news or just the market is worried about it. I don't know how worried the market is right now. Worried enough to get this far, worried enough to really set things in motion to make a lot of money on the downside? Not quite yet, not quite yet. So what do you do about that? Well, I'm watching this for the small caps. Okay? I've got a big bright red line here. And this is not as accurate when you graph the inverse of a, you know, of an index like this. But this would be meaningful if it broke out here. And if I look at the regular one here, good chance it's going to break out because the actual one has already broken down. One last thing I'm going to look at here is this. This is corporate bonds. When I started my core portfolio, which is kind of the side saddle, co-pilot, second in charge portfolio behind the main Sun Garden York portfolio in the service. Core is all ETFs, a little bit of options work, a little more basic, long, short type of thing, plenty of cash in that portfolio right now through T-bill ETFs. But when I started that portfolio, or I should say when I updated it for my old client base back in my advisor days, it was 2012, I believe. And I said, you know, the next decade for bonds is going to be rough. And most of my clients at the time were people that were more income preservation investors, not growth investors. Okay, I can have some preservation in the core portfolio, but I really need to make a bond substitute. And so I used my ETF work, and a subject of today's session, how using ETFs. I'll show you how I'm using them right now, but I'll also refer back to the fact that even though we didn't have the same amount of ETF flexibility back then, in terms of we didn't have 4,000 of them like we do now, probably had less than 1,000. There was still plenty of maneuvering that could be done. And you know what happened, and the benchmark that I would often use for that back in 2012 was corporate bonds, because I said, oh, everybody jumps past treasuries. Okay, well, you know, back in the day, I could get 6, 7, 8% on a triple B or a single A corporate bond. I think those days are over. And sure enough, I mean, on a price basis, okay, want to see how far back this goes? Yeah, it's had some yield, okay, but the yield has been lower and lower. Okay, but on a price basis, LQD, which has been around for a long time, is selling at the same price that it did, what, 23 years ago, 22 years ago? So, you know, and the price just cratered in here. Well, guess what? It may not be over, because we had such a long period of bond bull market. In fact, I will show it to you here with the 10-year, and then we'll move on to the next segment of things. And I'm going to see if I can make this one. Okay. I probably just opened some people's eyes going from the dark to the light. Okay, let's look at it this way. Okay, this is the 10-year treasury. That's 1981. And that yield, by the way, 158, that means it was a 16% yield at the top. Just move the decimal over. That's a 16% yield. Okay, I would bet that there's people here that remember investing in bonds or being afraid to invest in bonds at 16 because they thought they were going to 26, and they figured they would just wait. It's like a deflation situation. Why should I, you know, pay $4 for that burger if it's going to be $3.50 in a month and $3 next year? You know, so me, I'd just jump and get the burger anyway, regardless of the cost. So this is bond prices going up for decades, and guess what? It changed, and I am far from the only one. A lot of real bond gurus on the street, Jim Bianco, many others. I think Stephanie Pomboy is another one. Okay, I can show this to you as a chartist. Super simple. When did I start to really look to exploit what was going on in bonds? Here, right after the pandemic, and you know, yields were forced down towards zero because of the pandemic. Okay, but barring something like that, this looks up. It just may not get there in a straight line. And by the way, if I'm wrong, great. I can make money on the other side too. So what it, in fact, I won't steal my thunder for the next part of it. Okay. Problem with dividend stocks. Now that we've taken care of some of the chart work. So I'm just going to show you this. I actually worked this up right before. Let me see, which one did I put it? Nope. So we got a lot of stuff here. Okay, there we go. All right, yeah, I just put this together. I do a lot of work that gives me conclusions that I can write about. So I'll be writing an article about this. I'm sure on Seeking Alpha. So what did I do here? Well, I took the high yield dividend aristocrats index. It's S&P and beyond, about 133 stocks. So they supposedly have high yields. But let's face it, there's not a whole lot of high yield in there. Okay, there is at the other end. But this is the problem with dividend stocks. Okay, you don't find many of these anymore. So we have to get our yield in some other ways. Those of you who are football fans, is kind of like what a lot of these NFL teams do now, where they don't run the ball as much, but instead they try to use the passing game as an extension of their run game. So they'll throw the ball, 3 yards to a receiver, and it'll count as a pass completion. Okay, and the quarterback is, wow, he's completing 80% of his passes. Yeah, because he barely had to throw it anywhere. Well, I'm doing the same thing with income right now. I'm trying to figure out a way to expand the ways in which I earn income, because I think a lot of the traditional doors, they're not shutting down, but they're shutting down if you actually want to make money as opposed to yielding 2 or 3 or 4 and giving back too much in price appreciation. So I'll be exploring this chart a lot more, but take a look here. Okay, these are like the pristine, dividend payers, dividend raisers, and some of them did quite well. But you'll know, and this is going back more than 3 years now. Okay, we had a bad 2022, we had a good 2023, 2024 for Mag 7 and the like. Not for these stocks. They're still trying to get even, most of them. Okay, so the annualized returns on some of these were pretty good, but look at the yields here. I mean, with just a few exceptions, okay, it looks like a lot of them in the oil patch. Okay, there were not very high yields here. If you're looking at the high yields and how they have done, and granted, there's some cause and effect because stock price goes down, the yield goes up, okay, but it wasn't that dramatic. All right, these were the higher yielders, let's say, and look at how many of them, even when you include the dividend yield, have annualized returns for 3 years that are decidedly negative. These are annualized, and they include the dividend. So, I mean, I feel like the old V8 commercials, like, oh, I should have figured this out earlier. Okay, well, I've been tracking this for 3 years, and it's one reason why, except for a limited period of time last year, where I had 40 stocks in the YARP portfolio, I'm down to 10. And the ones I'm going to be keeping and adding to, maybe 10, 15, 20, then we'll see, I'm going to put option collars around. That's next week's session. So we'll cover that more. But the way we have to approach dividend stocks because of these problems is I believe something that, when I say nobody's talking about it, I mean, outside a little bit in the comment section, I do not see anybody in, let's say, a position like mine, run an investing group or have at least some sort of place where people will listen to you. I like to brag about being a D-list celebrity in this industry, not an A, B, or C. I just don't see people talking about this, and I think a lot of it is because it goes against the business plans of a lot of people who sell high yield, buy the dividends and sleep well at night, the whole swan crowd, as they say. I think it's cruising for a bruising, to quote one of my most favorite movies. All right, these are some pretty ugly returns in here, and and a lot of these stocks, I do it the other way here. Okay, remember, this is the creme de la creme of dividend payers. Okay, and look at how much they are off their all-time highs. That's a lot of problems, and it's not like it's getting any better, because since the market started to top, okay, look at how much you're giving away. And I'll just take EAX at the top. I haven't really done anything with that in a long time, but okay, great. I'm yielding 5.5%. Okay. But I've lost more than 4 times that in a matter of weeks. Okay. I'm giving you anecdotes here, but what I'm telling you is this is all over the place to the point where I just had to draw down the number of stocks I was willing to own without some sort of hedge on. Okay. So, and when it comes to ABL, avoid big loss, I know you probably can't see this. Let's see if I can increase it. Okay. All right. I've discussed in the past, when the markets get worse and worse and worse, my general approach for first defending, then exploiting, and I'll put it in round numbers. All right. The first 10% of a market decline, and I don't know if that's what this is, but if it is, maybe good that we talked about this. The first 10% of the market decline, I just want to lose less. The next 10%, I want to try to make some money. The third 10%, meaning down 20 to down 30 and then beyond, I want to crush it. I want to crush it to the upside. But if it happens that quickly, it can't happen. The most recent tale of this was in early 2020, S&P fell 33% in 5 weeks, and the main portfolio I ran at the time, core, was up 2.5. Now, there have been plenty of times where I have lagged up markets, and because that's the style for me. It doesn't mean that somebody couldn't take everything that I do, track it closely, and then say, I'm going to do everything that Rob does, except I'm not going to hedge as much, or I'm going to hedge differently. That's what the service is for. You can copy me step for step, but that's only one of many applications of kind of being part of this community, this club. So we're kind of in the beginning of that right now. I went back, I said, okay, when did the market really start to top out, to be determined whether that was a top of significance or not? So the S&P is down 4%, and the average S&P stock's down 6%. So, we got some stuff going on. And what you'll see from a YARP portfolio, pretty much this. It's gonna, because I'm not out there trying to hedge what I'm doing or exploit downturns when the market's roaring, which it has been. So I'll take a little bit of it, not nearly as much as the average stock. And remember, we don't have a lot of Mag 7 exposure, so we're not going to keep up with the S&P, over very short-term periods of time. But then as time goes on and the market starts to really accelerate going down, you'll notice this is kind of still following the same, if you will, angle of descent. This is starting to flatten out. Core is already flattened out. And this is just my little 2 ETF Roar Score portfolio, which is a good way for people to know, hey, if he's only got 20% of a stock cash portfolio in stocks now, whereas it was 40 not long ago, it gives you an idea. Okay, I think something's up, and I'm willing to be wrong because I don't really think of it as right and wrong. It's, do I want to risk this getting bad really quickly? No, I don't, because I never do. And that's me. All right. So doesn't mean I'm not always looking for ways to make money on the upside. Okay. So I mentioned the dog collar. One other thing I'm just going to show you in terms of this, just updates on the investing group, and certainly if you have any questions, whether you're a subscriber or not. I noticed this little ditty just before we came on here. This is the S&P 100. I wrote about this recently in Seeking Alpha, but I do study this a lot because the S&P 100 is, I mean, it's well over, I think, half of the S&P. The other 400 companies do not matter that much. year to date so far, it's early, but this is interesting, isn't it? Okay, that is what I would call a 2024 dog, not dogs of the Dow per se, okay, but definitely a dog, a price dog, okay. Same with this, and all the oils. Same with this because of the tragic incident and just generally speaking, the stock been doing that well. Another oil, you know, wrote about this one, owned this for a while last year, don't own it anymore. I wrote about Amgen recently, but I mean, this is like the who's who, except maybe for Meta. This is like the who's who of I had a bad 2024. So just these are things that kind of like, hey, take a note, okay? And that is not the reason for, but it fits right into what I call the dog collar, which is taking stocks that have already had their bear markets, buying them with the idea of hopefully holding them for a while, over a year. Let them make their comebacks, maybe some trading around the positions, but definitely putting either a collar or at least put option exposure, because even these dogs can get sort of thrown out with the rest of the stock market if things get really ugly. Okay. The last two things just relating to the subscription service. Okay, yeah, it's technically a subscription newsletter, I guess, but we do these every week and we have lots of interaction. The chat is an incredible tool, and those of you who are using it, thank you. I like this thing. I'd like to go on this thing, you know, like all throughout the day. I know I look at it occasionally on the weekends as well. I'll look at it at night. I mean, you know, we get alerted. So, but to me, this is so much better than a lot of the social media garbage that we try. The idea is that this is supposed to be an investing group based around, yeah, my thinking, but I'm just sort of throwing the red meat out there, okay, for everybody to use as they see fit. And the people that have tended to join us in the early going, you know, we've got a nice robust group so far, but obviously we'd love to make it bigger. You know, we're the people that are being attracted to the investing group for the most part are folks that I would call they're not just serious investors, they're contemplative investors. They like the idea of collaborating, even if it's kind of in an impersonal sort of, you know, chat and sessions like this. But, you know, to me, it's like having an arm's length investment committee, except everybody's a member of it. And I'm just the one directing traffic, and yeah, I can go deeper on the technicals and things like that. But I don't have a monopoly on good ideas, and that's what's so fun about running this, and why when Seeking Alpha asked me to be the latest one after not taking anybody out in that realm for maybe 9 or 10 months, we jumped at the chance. Okay, so now I'm going to zip through 5 different ways I'm using ETFs, and then we'll see if we have any questions. So the first thing that I am using ETFs for is because I want to own some stocks, but I want some cushion. So, I mean, I can, not too important here, but a good example, because these are all existing examples. This one comes from the core portfolio, the all ETF portfolio. One of the few positions I have in equities right now is in IYT. It's been there for a while. And originally I was attracted to it because I liked the chart patterns of Union Pacific, Uber, United Parcel, and guess what? Those 3 are 45% of this ETF, roughly speaking. It is market cap based, and these are much bigger than other transport companies. You've got some airlines and other things in here. But generally speaking, like a lot of ETFs I track, 49 stocks, but the top 10 are almost 3/4 of it. So this is basically what you're buying. So I would even say, and let's say a little more extreme example, if I had, I don't know, let's say, if I really liked, pick any of these 3, okay, UPS is the one I probably closest to. If I really liked UPS, but I felt like I wanted to sell out my straight position. Maybe it was for taxes, maybe it was just, I want to get a little protection around it. I want to get a little diversification around it. Well, it's a big position here. So you kind of know what you're getting by just looking at the top, right? I mean, these four stocks are half of IYT. So it just goes to show. So getting some cushion around these things is the way to do it. Second way I use ETFs is to trade off some unrealized gain for income. Right now, we're doing this with Aptly, which is a yield max ETF, which tracks Apple stock. So what I'm showing you here, and I'll increase this just a little bit. So one of the things I'm doing, because look, these products are still fairly new, kind of treading lightly with them. But we own this one and a couple others around the Mag 7. They have many others, but in fact, I don't mind telling you that I was kind of getting closer to having Moderna on my short list. Glad I didn't. Glad I didn't go from the short list to the portfolio, if you look at what happened today. Maybe it's an opportunity eventually, but YieldMax has a Moderna ETF where they basically use an option strategy around it to get a good chunk of the ups, and you can see that here. Okay, here's Apple spiking last year, and here's the YieldMax version of it, Aptly, getting most of it, but almost all this is income. And so if the stocks are doing well, you have to have the stock doing well. If the stock is doing well, or at least treading water, you can make a lot of income from this. And I am fine in these cases because I run an income-oriented portfolio. I probably wouldn't own Apple outright, but I would own it in this form where I can convert a lot of that gain. Instead of waiting to sell it and taking the unrealized gain, it will pay me every month in income. So I like this structure. The other thing I would say is what I said a minute ago, which is you have to have the stock going up. Well, I'll be a little patient with this for now. I'm not going to ride it down all the way because, again, when I spoke to the managers directly, they said to me, assume you're going to get about 80% of the ups and 80% of the downs over time. Well, guess what? That's about 80% of the downs since Apple started falling on December 26th. So, they're not a panacea. And that's why, as much as I like these products, I am very much, and you'll see this later this week, and I'll talk about it in the next session, live session. I am taking a lot of the matters into my own hands in terms of taking hopefully longer term stock positions in these fallen angels, dogs, whatever you want to call them, and putting some options around them for mainly for protection, but also because there's really no limits to the upside, and if somebody either doesn't agree with that or doesn't understand, just let me know. There's no limits to the upside for what I'm kind of pivoting to in the equity portfolio. Okay, third thing I use ETFs for, to avoid picking trying to pick winners in a commoditized industry. MLPA is the so-called energy toll collectors, the pipeline companies, these LPs. And again, you've got a very concentrated one at the top. There aren't that many companies in this industry. I mean, there's 21 in the ETF, and they make up 90%. And you can see these three are nearly half. So, I mean, these stocks will beat to their own tune, but not all the time. Generally speaking, it's a commoditized industry. They all do some version of the same thing. So I have decided that when it comes to things like this, I'm far less likely to buy one of these. I don't think I've ever owned one of these individually, but I've owned 3 or 4 different types of these. Okay, so that's the other way to use ETFs. Now I'm going to get the last two, which are, oh, let's say potentially the exciting ones in 2025, if what I talked about technically earlier in the session comes to pass. So first, I talked about 30-year. I think I showed this chart to you before. So, what I really want to get at, okay, if I see a picture like this, I say, wow, that could really be a spike in 30-year treasuries. Well, the last thing you'd want to do is buy 30-year treasuries, because if the rate does end up spiking, and it could be 30-year, 10-year, 20-year, anywhere out there, if the rate's going to spike, well, the price is going to get crushed. There was this phenomenon I could never understand a couple of years ago, where TLT, which is the ETF that is most popular for people wanting to buy the long-term treasury, an unbelievable amount of money went into this thing in 2023 and 2022 on its way down. I think it went from 10 billion to 60 billion in assets in a couple of years. All the while, people are throwing money in and they're just losing over and over and over. Then they finally got a nice bounce and it gave it back. They finally got another bounce and it's giving it back again. I don't know what's going to happen here. I just know that it doesn't look good unless you flip it upside down and you look at TBF, which used to be a big ETF. This thing was, I think, $750 million in assets. It's like 80 million now. Okay. And once again, I cannot believe, maybe because the levered products are levered versions of this, but this just takes TLT basically and it shorts it. I mean, it uses swaps and whatever. It's a little bit complex. Okay, so I'm not going to take a humongous position in it, but I mean, this is one of the recent buys in the Sun Garden Yacht portfolio. If I really, really start to see this thing look like it's going to be a juggernaut and volatility is still low enough, I will go back to TLT and I'll use the ETF a different way. I'll start looking to see if I can buy some way out of the money call options. I do this in my trading accounts all the time anyway, but maybe I'll go out several months, I'll buy way out of the money call options, and I'll say, I'm sorry, not call options, they'd be put options in this case. Okay, TLT is extraordinarily liquid. And if I come to believe that, wow, it's bad enough at 85, maybe this thing's going to 75 or 70, I can put up such a small amount of money, and that's all I can lose. How much can I make? A lot. And this is how I navigated in 2020. This is how I navigated in 2022. And I'm not afraid to do it again. So it's not just exploiting secular bond bear market. Okay. It's also things like I discussed earlier with the small caps. Well, this is IWM. And I showed this to you before, but it's got my little purple lines and circles on it, okay? That looks like a breakdown to me. Can never say 100%, but that looks like a breakdown to me. I used 70-75% before, talking about with the NASDAQ or the SP would break down. This looks more like 85%, maybe 90. Doesn't mean it can't change, okay? Some news event could happen. Something. The charts are not foolproof, but they help us put the odds in our favor. I'm liking this, and we'll see. The other clue I'm getting is my favorite momentum indicator, percent price oscillator down here, is doing what it does when this thing's about to fall through the floor. Okay. Now, even if it does, it could just be the final salvo. However, I believe that the market and economic situation and the concern about rising rates and how it will impact small cap stocks that have to borrow to keep going for the most part, I think that that's going to weigh on the market a lot more than it did a couple of years ago. Again, I don't know for sure, but I know enough to say, wow, maybe I'll eventually step into RWM, which is the opposite of this. So it looks pretty good right now. Or maybe I will go a step further and take IWM and buy put options on it to try to get that big move. We'll see. We'll see. So those are the 5 ways. And now we're up to ask me anything. So, and I actually see that I have a couple of questions. Let me get to those first. You are welcome to go on. Hopefully everybody can get off of mute pretty quickly. Let's pull up the charts here. There we go. Okay. I have a feeling we need those. All right, let me see. So you can add your questions to the chat, or you can or you can just speak up, but I'll answer these first. Okay, let's see. All right, do you think some of the interest rate increase was a short squeeze, but I agree federal debt way too high? Whew. All right. There's a lot of stuff that's above my pay grade. That's what happens when you're a D-list celebrity. You know, I do not know. Is there a short squeeze? Maybe there is. I mean, it's a common explanation for a lot of things. I will tell you that, and I kind of put this in the Seeking Alpha piece, the 3 T's. I mean, I think that the bond market, I mean, think about who the biggest owners of bonds are, right? Okay. Chinese, Japanese, OPEC countries, now, and I guess US pensions, and of course the Fed. But they're all sort of drawing down their holdings for different reasons. But the one thing that is common is I don't think that the US is offering a high enough yield for these longer term bonds. I just don't. In fact, I'm going to pull up that yield curve again. This is where I get it from. US Treasury yieldcurve.com. Let's see. Remember, this was kind of long overdue. And look, I mean, the jobs report, yeah, the excuse was, okay, inflation's coming back, etc. Maybe it is. I mean, if inflation did not return to higher levels than we saw last year, I think it would be the first time in a long time. Inflation almost always boomerangs. So maybe there's some type of short squeeze possibility there. I will tell you this. One of my main reasons for being very friendly to the idea that whether it's TLT put options or something like TBF, or dare I say, even TBT, which is TBF times 2, or inverse TLT. Okay. Yeah, that's looking to have some good price momentum there. And even if it got back to the old high, I mean, that's 15%. Not bad for bond related investment, right? Sure beats coupons. And to me, this is what the bond market has become. I wonder if I can show it in, yeah, I think I can show it here. I'll go on to the next question. Okay, let's see. I'm gonna just quickly pull up here in the Y charts. TLT. And I want to see what the 6-month total returns. Actually, I'm going to do the price returns monthly. Smooth out the data a little bit. Okay. Oops. There we go. All right. There it is. Okay, so let's see. This thing's been around since 2003. And what I'm looking for here is, okay, in a given 6-month period, have the gyrations gotten any bigger? And to my surprise, I don't think they have, but it's been marginal. Maybe if I did this over shorter periods of time, but whatever I'm looking is over here. Okay. You see a 10% move up or down in 6 months was fairly standard back here. Then you had the financial crisis, which of course drove these things down because all people wanted was treasuries. So kind of have to blank that out. Let me bring this in here. Yeah, I think what I'm seeing here, go back to this. Okay. I think what I would say, I don't think I have my little drawing thing here, but just look over here. Okay. I mean, you did not often get in fact, in the entire 22-year history of TLT tracking 20 to 30-year treasuries, you did not see a price decline of 10% too often, and occasionally you get 15. Well, in the last few years alone, okay, and this does not even include the dailies. I'm sure if I did the dailies, you'd see more. It's getting wider. It's getting wider. And I see a lot of -20s. This is 6 months, okay? -20s and +10s, great. Well, that's kind of like saying you'll make it up in volume, right? And that to me is what this picture is telling me longer term. That the big win for income investors, ironically, in the bond market could be to be trying to profit from price declines in the long-term bond market. Okay. All right, let's see. Dollar strength. Oh. Yeah, I mean, dollar strength is I mean, it's certainly a part of it. I've been waiting for the dollar to like do something other than this for the longest time. Pet theory, I don't know what people think of this, but I do wonder if this Canadian 51st state thing, I mean the chatter, not the actual possibility that it would happen. I'm starting to wonder if Canadian assets in general might start to look a little bit more competitive simply because of the dollar potential for the Canadian dollar to be seen as yeah, close to the US, but not the US. I'm totally just hypotheticalizing here. But I've been thinking about that recently, especially because some folks, including some of our Canadian subscribers, have brought up some things to me. I was like, wow, I look at a lot of Canadian stocks, maybe because a lot of them in the oil business, but some Canadian stocks look interesting, maybe they'll end up in the portfolio. We'll see. All I'm saying is, if the Canada dollar were going to bottom somewhere, at least based on the ETF price, wow, you sure would expect to do it right here, wouldn't you? Matter of fact, I'm going to mark that. Okay. And again, the ETF is not the same thing as the currency, but, sometimes these things rhyme. And, this is as far as it went. And believe you me, if I ever come to believe that there's a serious possibility that simply owning more non-dollar currency or assets in non-dollar currency can make me 20% over a period of a few years, that's like a dividend. It's like an extra dividend. We'll see. We'll see. I'm up for anything that avoids loss, big loss, and allows us to make some. Okay, let's see. Hopefully that gave you a little bit on dollar strength. Okay, let's see. Not getting political here, but wonder if you see a pop in the stock market, perhaps temporary, after Trump's inauguration, honeymoon period. Okay, excellent question, because I think what the market may be telling us right now is that, and let me shorten this up. I'll even shorten this up to let's see, I'll make this a simpler chart if I can. We're down a 30-minute chart. Okay, so I think this was the honeymoon, folks. I think this was it. Because what's that old expression? It doesn't get any better than this. Yeah. So by definition, what does that mean if you're a geek like me? Well, if it can't get any better, there's absolutely no chance it can get better. That means there's 100% chance it get worse, and nothing's 100% in investing. But when I started to see this, I said, okay, if this doesn't hold, this market can get very heavy, quote unquote. And now, with that said, and you're seeing it, okay? This is, in fact, I think I put this in one of my articles recently. I literally, the title of the subheading was UGLY with dashes in between them, okay? That is a very ugly, I would say more a better word is ominous. That's an ominous looking chart for the S&P. That is similar for the net. Doesn't mean it can't save itself, okay? But then I go and I look at, let's see. There are exceptions to the rule, okay? The Dow doesn't look great in total, but there may be parts of the Dow that do. There are stocks, I mean, I wrote about Lockheed Martin, okay, for Seeking Alpha the other day. It's early, but yeah, I'd rather focus my attention on a stock that is selling at, let's see here, and I don't own it, by the way, okay? It's part of that sort of dog collar group that I talked about, okay? So, I mean, this stock's gone nowhere since 2020. It's also, boy, right on time after the article, and I pointed this out, that, if anything, it would be due for a bounce here. And sure enough, why is Lockheed up? I mean, I'm sure there's fundamental reasons. I haven't really tracked it today, but there's a lot of stuff like that out there. This is where I think we have to be looking. It's not even like, let's buy let's look at the average S&P stock. It looks pretty bad too. It's going to be very, very, very slim pickings here. There's a lot of things that are kind of early stage breakdown. The market always manages to save itself. Maybe the news is such now that won't happen this time around. We shall see. Okay, let's see. Yeah, I think we'll see I mean, it depends what you mean by pop. So to me, I mean, yeah, because I do have trading accounts that I mess with every day for a bunch of reasons. Okay, if you mean could it pop back to here, which would be what, about 3% move after what we just saw, I could see that pop, no question. But that's why I chart in multiple time frames, because the further out we get, the weepier this starts to look. I think weeping willow tree, okay? It starts to look very, very weepy out here. Even the monthly, which is not worth talking about too much yet, but yeah, when that starts to really look bad, no good, okay? Remember, I draw these lines before these things happen, so in most cases. So it's a matter of coming back and saying, oh, look at that, it broke through where I said, oh, if it breaks through, okay. Unlike the parent who says, if you do that again, you're going to be punished, and they never punish them. Okay, let's see. Do you ever buy US Treasury bills? Yes, instead of the ETFs. I'm tempted to buy some 10 or 20-year bonds. Okay, bills and bonds are different things. Okay.
I always forget which is which. I know one's the long term, longer than a year.
Yeah, the bills are I own bills as we speak. I mean, I've owned individual T-bills. It's been a long time since I bought very long-term bonds. I think I'm not sure where I'll fit this in, but one of the things that I'm looking at, and I will have probably a whole session on this, is, I mean, look, going out a long way, it's okay, but you could end up with a lot of price volatility. Here, let's see. This is IEF, which is the 7 to 10 year treasury. Okay. So it has been trading in a range of 10% or so top to bottom. if all it ever does is trade in that range, no big deal. If it breaks through and gets much worse because rates are going up at the 10-year level, then, I mean, you'll have hopefully a secure investment in a longer term treasury, but I don't know if it will be a very uncompetitive investment. Okay. What I'm looking at, just to sort of give you a quick clue here, is a very simple formula where you can go out a few years on the curve, lock in. I mean, let's say the 3-year gets to 5%. If you can buy a 3-year bond, even a zero coupon, perhaps, buy it at 85 cents on the dollar, mature it at 100, take the other 15 cents on the dollar, and invest it more aggressively. I mean, you could buy options, you could buy leveraged stuff, you could just buy, something more risk tolerant than you normally would. Pretty good combination, and I think we're getting close to that. Let me see. Okay. All right. Yeah. Do you let me see here. Tariffs may cause more downside for Canadian dollar. Yeah, I'm no Canadian dollar expert, so thank you for pitching that in. Let's see. Okay, and then good question here. Ken Druckenmiller and buddies have indicated that the big short position, but the bond market is huge, so I doubt a squeeze is happening. Long-term trend on rates just appears to be up based on macro expectations. Yeah, that's a much tighter way of saying what I probably took 5 minutes to say. So thank you. Logical extreme is U.S. government is becoming an over-leveraged commercial paper issuer on fentanyl. Apparently he's not here. So I will say thank you for the chuckle. Yeah, I mean, look, this has been the elephant in the room for like 15 years, right? I mean, think about what's happened since the financial crisis, and we were still pumping, quantitative easing and making money loose when we were nowhere near a recession. We were in a boom time. This is one reason, unfortunately, why I think an entire generation of investors, especially the younger folks, not to mention a lot of baby boomers that maybe picked up investing recently and said, hey, I'm pretty good at this. Not saying that you're not, but, genius in a bull market. And it's been a bull market. Not necessarily for about a third of the S&P 500, not even close, but so much has gone on because you have this concentration at the top of the small number of companies dominating. Okay. All right. Let's see. Another question. I'm retiring in 2 years. Would like to actively trade a portion of my investment account. Would the YARP portfolio be suited for me, helping to grow my portfolio? Well, thank you for asking. It depends what actively trade means. I do a ton of trading, all with a specific purpose. When I say trading, I mean literally, I could buy something today, sell it tomorrow. I could buy something today, sell it later today. Am I doing it with a lot of money? No, I'm doing it with a fraction of a fraction of a fraction of a percent of my whole portfolio, but I'm doing it for a reason. That is what I call trading. And it's really just, if you will, trying to put small amounts of money to work to see how things go. If I can invest $1 and make $1 on it within days to weeks time, I'm willing to risk the $1. I'm willing to risk $100. I'm willing to risk more than $100. Am I willing to risk $10,000? $100,000? No. So that's the trading. If we look at the actual portfolio, and let me see where I put it. There we go. Okay. So, all right, this portfolio, this is probably a good review for a lot of folks too, so I'm glad you asked. Okay, active is on a very long spectrum. right? From day trading, which is not what this is, okay? Is there some swing trading in here? Meaning I would hold something for a matter of weeks or months and not just buy and hold? Absolutely. However, I am trying to isolate that part of the portfolio more and more. Why? Because it's not as easy to pull off than it was last year when, and we have the whole history of this, but okay, 3M is a pretty good example that comes to mind. Yeah, it was great to be able to buy 3M. I think I bought it at the beginning of May, something like that. Okay, so to buy 3M like around here and have it vault higher, okay, and then it just stopped. Or I mentioned Lockheed before, which I had owned for a while. Okay, but in the article in Seeking Alpha that came out a couple days ago, okay, look at this round trip. This is typical. This is your equity market today, ladies and gentlemen. Okay, where you can see a blue chip stock go from 460 to 615 or so, 620, and all the way back to about 460, and it's all happened since midsummer. That's ridiculous to me in terms of it's not synonymous with buy and hold investing. And this is one stock I could show you 100. Okay, I can show you 100 within the S&P top 200. All right, this is the stock market today. It's algorithms, it is hedge funds, it is lots of newbie traders, it is 0 DTE, days to expiration options. It is so much stuff going on. And so to me, I think being more active is almost an imperative. How you are active, that evolves. It's even evolved since we started doing this, some months ago. The stock portion is going to be a little bit more buy and hold, but with clamps on it with options. That'll be next week's session. I'll be writing about it quite a bit. I'm putting the portfolio together now. But supplementing that with some income ETFs, with some offense ETFs, meaning, I find something, I mentioned the transportation sector before, I buy it for a little while. I hope I can hold it for a long time, but more likely it's going to top out on me. Okay. Give an example. Okay. I mean, you see this all over the place. I've owned this probably a few times, but what happens is, okay, I mean, this is the transport sector. Okay, these are not fly-by-night companies. They're popular businesses. They're well-run businesses. This is like high-quality investing. They don't yield a lot. They used to, but they don't yield a lot now. And all you've gotten is paltry, maybe 1.5%, 2% dividend yield since the middle of 2021. So I'm trying to give you here all of my reasons, my rationale for why I think active management to some degree is an imperative. But just doing it by day trading, that's a whole other channel, not this channel. However, what we do here is we do things in a very structured form. At least I do. It's up to everybody here because it's not a discretionary investing service. I manage discretionary money, client money for almost 30 years, but now I'm a semi-retired do-it-yourself investor, creating a club for do-it-yourself investors with the help of Seeking Alpha. That's basically what Sun Garden York portfolio is. As opposed to the clients back in the day, generally had $2-3 million with us or more. They would pay us 1% fee. So I think the average client was paying 25 grand a year. I mean, of course I'm biased, but I think, $1,500 a year to be part of this is not a bad deal. Versus what folks were paying for that, some of the investment work back in the day. And so, I think you have to set up a portfolio that is active, but I think the options are potentially a game changer if volatility stays too low. I should say if it stays low. And so are defensive ETFs. So it's not just active, it's how are you active, and it's combining a lot of different things, setting some allocation ranges, setting some max min positions, and then going to work and viewing it all in what we call a depth chart, where at least you have one person's opinion, mine, on an ongoing basis about what do I like more than other things and that type of thing. Okay. All right, let's see. Okay, yeah, market hasn't made sense since COVID for value investing. There you go. There you go. You know what? I think we're getting closer. I do think we're getting closer, but it's going to be isolated cases, very isolated cases, and it's not going to be a straight line. And so here, I'll take the big one from today. Okay. All right. I hope nobody's bragging about having owned Walgreens. Because unless you bought it very, very recently, okay? But these are the things that in my career I've always made note of, okay? I would love to be a long-term investor in Walgreens or something else, okay? And yeah, this is starting to look a little bit more encouraging, but boy, is that a wall to climb. So as I see it, I don't want, and this is a pretty good example of what I'll talk about a lot pretty soon. Okay, let's just draw some quick lines around this here. So, I don't know. Let's just say that this is what I think is the old support and resistance for this thing. Okay, I'm just drawing it very, very quickly. The stock's at $12. Do I want to own it at $12 with the possibility that the little bit of good news that's brought people back to it drops it back down to $8 and maybe below? And maybe with this one, it's even, deeper doo-doo than that, given what's going on with the business and the industry and the way they make money at places like Walgreens and CVS. But if the stock's at 12, and I thought, okay, well, it could easily get thrown back to 8, it could go to 16 on the way to a lot higher. But for now, let's keep it calm and say 16. Well, if I've got that kind of upside downside, first of all, I probably wouldn't be that interested in it. If I thought I had this type of upside downside, I'd be very interested in it. However, I'm not going to buy this all by itself. And what I had been doing for the longest time is buying things like a 3M example recently. Buying things, I'll buy 1%, I'll buy a 2% position. And then as I start to get more confidence and the chart helps give that to me and nothing breaks fundamentally, then I can get it all the way up to a 5% position. That's what I call position sizing. That has not been a good strategy for several months now. And I've come to the conclusion that it may not be for a long time because the markets are changing in ways that they may never change back. But I do know how to use options. I love teaching people how to use options. And I love teaching them without all of the Greek language. I don't speak Greek at all, ancient or option. I think you'd probably be surprised at how little I know that, compared to some of the other folks do. But I've had pretty good run for 30 years with options just simply by saying, hey, wait a minute, you mean I can take this $12 stock and I can set it up so that for the next X number of months, the worst I can do is 11 or 10. And then I can also get upside to here, no questions asked. And then my biggest problem is not it sneaking below here because I'm protected there, max loss, okay? But my biggest concern is, what if the stock pops and it's on its way to 20? Well, if I own a put option here and I sold call options here, I might be obligated to sell it. Oh, woe is me. I'll have to sell the stock at 16. I guess that caps my upside. And my question is, why does it cap your upside? You can buy more shares if you like the way it's going. You can buy a call option to put up less money. These are the things I do in my trading accounts over very short time frames. And so I finally realized that this was a great time with the platform of the investing groups in Seeking Alpha, Sun Garden York portfolio, that this would be a great time to kind of break out my greatest hits from how I've used options, not just in long-term portfolios like we do, in the service, where we're buying a couple of option positions, generally around the broad market S&P type thing. I'm talking about the way I use options in my trading accounts, but even more than that, the way I used options when I ran a couple of mutual funds back in the day, and where it was one big portfolio and it was easy to maneuver. And I would do things like this. In the year 2007, back in my client advisory days, I started a portfolio that was only stocks with collars around them. And it's been 18 years. It worked out really well in 2008. We did not lose money. I think we made 1% or something like that. Try to do better this time around, but I think I'm bringing it back. And that's the next wrinkle, which I think, frankly, might put some people who might have been on the fence about using the service to that, because it is not a lot of moving around. It's not a lot of trading, but it is, I think, a healthier way to own companies that have been maybe unduly punished. I mentioned this one before, maybe unduly punished. But the businesses are still solid. And I call it the dog collar because they're dogs, and because I'm putting an option collar or some segment of an option collar around it. So there you go. All right. Any other questions? Happy to take them. Otherwise, we'll close up shop for Monday.
All right. No, sounds good, Rob. That was interesting today.
All right. Thank you. Anybody else have a question? No. Okay. Yep.
Yeah.
You're welcome. Yeah.
Eugene, yeah. You mentioned several times your trading accounts and your shorter term things. Is there any intention of sharing your thoughts, processes on those with us so we could participate?
So give me a specific example. And by the way, I'm seeing just 1 second. Let's see this one. Oh, how to make a portfolio look more like YARP. That's going to be so much easier to answer in the next session next Monday, and you'll get a lot of it from probably what I blogged this week. So okay, now but it's an important question, because I'm constantly, I think, if I showed you, what I do kind of messing around, okay, but the messing around is very, very serious. As an example, okay, I am, well, from a trading standpoint, okay, I'm loaded to the gills in put options on IWM as we sit here, okay? Why? Because I have a teeny tiny amount of money in them with a strike price of like 200. So that would be an example of something that I'd love to let people know. The easiest way to let them know, now that I think of it, would be through the chat. Now, and I don't think you want to see everything, but although frankly, it would probably be good for me too, because if I know that I'm sort of, talking about my trading stuff like that, yeah. But look, is that a trading position? It is now, okay? But it's almost like a minor league system, if you will, for maybe going and doing the exact same thing. The difference with the trading is very short attention span theater. I want to make sure, if you will, I'm going for the quick home run. It happens a lot. Sometimes it doesn't, but when I want to get more serious about it, I've already kind of seen how it moves, and I'm getting a pretty good, I'm focused in on it. So I may start with it in a short-term trading account, but I don't mind telling you, I mean, I'm probably within days of either If this doesn't reverse itself soon, I can see this going in the portfolio, in the YARC portfolio. Or I can see going to IWM and starting to look at something like, oh, here, I mean, I think this is, I would go further out than I have here, because again, I don't want the time to creep up on me. I don't know, maybe I'd go out 3 months, something like that. Let's just see what this looks like. Give you one example. Okay. IWM's at 217. This is simply about playing chicken with the market. So it's going to cost me $3.50, $4, okay, for this thing to kick in if it falls below 200, so 8% decline between now and 3 months from now. Well, I'm not doing this because I think it's going to do that. I'm doing it because I want to see if there's a chance it goes to 180 or 160 in a panic. Because not only will this thing be worth not $3, $4, but at 160, it'll be worth $40. If I took 0.5% of the portfolio and put it in that, I can't lose more than 0.5%. But if it goes up by 10 times, I just added 5% to the total return of my portfolio. That is high return on investment to me. And that's a quick and dirty example of how the trading stuff can integrate into this. And I welcome suggestions. Really, I mean, tell me what you want to see, and I'll make as much of it available to subscribers as possible, because honestly, I would, as a matter of fact, I'll take the here. All right, we'll close the session there. I'll shut the recording and say a couple of final words.